Welcome back. You're still tuned into Trading Hour on CNBC TV 18, where markets, they continue to trade higher. 90 points of an uptick that we're looking at for the Nifty right now. So steady at the 24,550 mark. What's doing well, of course, is the Bank Nifty. That is the one that is supporting the gains that we're seeing on the benchmark as well. In the broader markets, we have some of these names, the likes of Honasa, which after that big fall is making a comeback. We've seen that the promoter group has bought some stake, Varun Alagh that is. On the back of that, that stock is higher by around 10%. The Graphite India is higher. We do have some of these names like UCO Bank, Central Bank of India, IOB, some of these PSU banks which are doing really well in trade. And let's talk about Aurobindo Pharma as well. That company's name tagged in news related to Auro Infra and Kakinada Seaports. They are doing, there is a clarification which has come in, and they say that they're in no way connected to these two names, and that's why there is a recovery on the stock after this clarification that has come by from Aurobindo Pharma as well. We'll of course get more details on this one. But for now, let's get some some fundamental conversations going on the markets. Devang Mehta from Spark Private Wealth Management is joining us now. Devang, good morning. Thank you so much for joining in. Well, that's the next question. Now that the first half of earnings disappointment is over, what's the outlook for the second half? You're almost done with most of the quarter three, data as well. What have the conversations suggested that you have had with corporates?
Good morning, Sonal. Thanks for having me on the show. Pleasure to always be on CNBC TV 18. I think very clearly we are past that earnings. There was a narrative of earnings downgrade. There was a narrative that money would flow towards US risk assets after the New World Order, after Trump was elected. Also, I think the thing that money would flow towards China, that has also sort of waned away. It just happened for a brief while, and then again, I think after this correction, and that correction which was seen because of one, the earnings not meeting expectations, and second, of course, we saw the GDP print, right, which was more a lag indicator for the markets. Yes, you are absolutely right that I think people have now again sort of shunned that in the next couple of quarters, the earnings are bound to come. We know that around 7 trillion rupees would be spent by the government in the next 4-5 months to again spur the infrastructure and the capex that was slowed down because of the general elections, the state elections, and many such events in the last 7-8 months. I think the next 4 months, we would see a lot of capex, private capex also coming back to the fore. I think the marriage season, the wedding season also, what we are talking about is again going to see a lot of consumption coming back. And I think if you hear a little bit of green shoots from the rural economy is where a lot of people are also talking about, a lot of corporates which we met are saying that yes, that there was a time of that the last quarter was a bit of a hibernation. But I think I was very encouraged by the commentaries, the positive commentaries of companies who are in the capex universe, or companies who are talking about growth plans as well. And I think everything seems to be on track. So my sense is after this 10% correction, we have seen 5% rise again. I think this is good time again to go back to the drawing table, look at the sectors and themes, revisit them. And again, I think it's good time. Maybe probably there will be a couple of months of time correction more, but I think no problems emerge as a larger type of problems for the market.
But is there a risk that this expected recovery in the second half of the year doesn't play out? So much of the heavy lifting in terms of an expected pickup in capex, green shoots in rural consumption. What if it doesn't play out? Is there a risk to that? What have you heard from the corporates?
So, of course, there are always two parts to it. And you can probably look at the optimistic part of it and say that the recovery will happen. But yes, the question is absolutely on the right track, that if it does not happen, I think, yes, then maybe a bit of valuation correction, a bit of time correction. Yes, earnings, probably we talk about 8-9% type of single digit earnings growth for this year. Which is for FY26, there is still expectation of 18-19%. That may be pruned to around, say, 14-15, mid-teens type of an earning expectation, which may lead to a 4-5% correction more on the market side. But yes, it may again, I think the times that everything and anything would do well to be over. The time of easy money seem to be over. Now one has to be very, very focused on the quality of earnings, on the quality of growth, and most importantly on companies which are generating free cash flows. That is, I think, going to be a paramount importance, that everything and anything would not do well. You have to be very, very picky and choosy about what theme and what businesses particularly you are going to buy. So yes, there is the risk, probably a downside risk if the recovery on the rural side as well as the recovery on the capex side does not happen.
So what are you looking at buying right now, Devang? We have seen that fall, but there's been a recovery from the lower levels as well. Any segments that you think are still looking reasonable?
I think, yes, most of our segments, which we have been very positive about in the last 1.5, 2 years, we're not seeing any correction because of the market momentum we saw. But yes, I would not say thankfully, but we saw some correction in some of the segments. We have been extremely bullish on something in power automation, power ancillaries, a company like Hitachi Energy, which I talked about on your show, I think at least 3 or 4 times. We like the business after seeing a correction of 20-25%. The company is right now at an EPS of 22 rupees, and the EPS is going to go to around 180 rupees in the next 3 years. This is one theme we are extremely positive on. We are very positive on engineering / manufacturing type of themes, stamping and lamination type of companies, engineering companies. ER&D has been one of the segments that we have been bullish on. EMS is another segment. I think these are segments which are linked to manufacturing, segments which are linked to FDI, segments which are linked to PLI. I think this will do very well. Another business which immediately comes to mind is something called port infrastructure, right? Port end-to-end logistics. We have been positive on a company called JSW Infra since some time, and I think this is a company which is sort of growing at 35% on the revenue side in the last 3 years, 34-35% EBITDA growth. It's being looking at inorganic acquisitions, doing a lot of end-to-end logistic work. I think these are the segments of the economy where if the GDP growth is going to bounce back, if capex is going to come from either government or private, I think these segments will do well. Apart from it, yes, you can't forget the consumption universe, which has gone through a bit of correction, a bit of, I think, discretionary consumption, travel, themes like travel and tours, themes like aviation. I think these are segments one should look at. We are not buying all these themes, but yes, some of those are on the radar as well.
Okay. Any clear avoids for you for the next 6 months?
I think the sectors somehow where there would be a lot of global dependence. I would not say it's a complete avoid, but on a case-to-case basis, if there is a lot of dependence on China, for example, we don't know the trajectory of China, whether it is again going to slow down or there is going to be some recovery coming back. So sectors like metals, where somebody has made a huge sort of money, can probably be on a little bit of sideline. Again, I'm saying that 6 months to 1 year, there can be cyclical recovery. But for a 3-5 year horizon, you can avoid sectors which have huge global dependence. And something which is domestic centric will find more favor in our type of portfolios.
Okay, all right. Take that point, Devang. Thank you so much for joining in today with those with the fundamental outlook on markets and specific sectors as well. That's the word coming in from Spark Private Wealth Management. Time for a short break now. When we come back, we'll get you more on the markets on the other side.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC TV 18 budget headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC TV 18